Hi guys. Today we will analyze Alibaba stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Alibaba is a bad performer in the overall market. Both the medium and short-term trends are negative. Support levels are around $88 and $76. The next support level is around $60. Resistance levels are around $115 and $127. The next resistance level is around $140. In the last month the stock has been trading between $99.33 and $129 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 22 million. This is a good sign as it is always nice to have a liquid stock. Alibaba is currently making a new 52-week low. This is a very bad signal. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 40% per year, for last 5 years. We see that the average profit margin of the stock has been around 21% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 145% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Alibaba Company: bad, average, and good. First scenario. Alibaba will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 10%. Future profit margin would be a low, 16%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $178. Second scenario. Alibaba will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 12%. Future profit margin would be average, 19%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $256. Third scenario. Alibaba will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 14%. Future profit margin would be high, 22%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $357. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.79. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Alibaba, analysts forecast growth rate around 10% per year in next 5 years, and future P/E around 14. Again, I will use 3 different scenarios for Alibaba Company: bad, average, and good. First scenario. Alibaba will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 10%. Future P/E would be a low, 16. In this case, the fair value of the stock today would be $52. Second scenario. Alibaba will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 12%. Future P/E would be average, 20. In this case, the fair value of the stock today would be $76. Third scenario. Alibaba will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 14%. Future PE would be high, 24. In this case, the fair value of the stock today would be $107. As you can see, today the stock is fairly valued, $100, if we expect the company's high performance in future. The fundamentals are good. And the stock is currently fairly priced. However, according to the last earnings report, Alibaba's growth is slowing. The revenue is expected to grow only by 10% on average over the next 5 years. I own a small position, 3% of my portfolio, in Alibaba. My cost basis is around $125, and I may nibble more if the stock drops to $90. Company's strengths. Alibaba Group is one of the world's largest online and mobile commerce companies. It operates its marketplaces as a platform for third parties, and does not engage in direct sales, compete with partner merchants or hold inventory. Alibaba is connecting buyers and sellers and making it possible for them to do business anytime and anywhere. The company operates in 4 segments: core commerce, cloud computing, digital media and entertainment, and innovation initiatives. Alibaba has become a global brand and now operates internationally. The company is financially healthy and should not expect problems in meeting its short-term obligations. Alibaba has a return on assets of 4%. This is better than the industry average. The company's profit margin of 8% is amongst the best returns of the industry. Risks. On February 24, 2022, Alibaba posted the slowest annual top-line growth in its history as a public company. The company is facing lower domestic consumption spending and increased competition that is slowing growth in its core business. At the same time, profitability is being hampered by reduced volume leverage, higher logistics and other costs, and investments in growth areas. The company is also being hurt by a deteriorating environment for large-cap tech companies in China as the government cements its power. China wants companies to share their data with the government. Alibaba's recent antitrust settlement demonstrates that companies in China have little recourse but to accept the decisions of regulators. Alibaba is the highest profile target for President of the People's Republic of China, Xi Jinping, and his CCP allies. The revenue is expected to grow only by 10% on average over the next 5 years. Based on estimates for the next 5 years, Alibaba will show a medium growth in earnings per share. The EPS will grow by 15% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.